Hi and welcome to Swissquote's Daily Market Talk. It's Monday, March 31st. The tariff talk remains on the headlines as the Liberation Day approaches. Risk appetite is nowhere to be found. The US dollar is weak. Gold, on the other hand, continues to extend its gains into the uncharted territories, and oil bulls remain quite unreactive to the news that Donald Trump is pissed off with Vladimir Putin for unveiling his plans for the next Ukrainian leadership. What a hectic way to start the week. So last week ended with steep losses for US and European equities as the tariff fears led investors to take risk off the table. Because remember, Donald Trump said that he would impose 25% levies on auto and part imports, and also is expected to unveil reciprocal tariffs this week on April 2nd, also called the Liberation Day by Mr. Trump, and the news are expected to go down quite roughly the investor and markets throat. Because tariffs are obviously not good at all for doing business, as they will make the cost of producing and importing goods to the US higher. Hence, they will boost inflation at a time inflation is already showing signs of quickening in the US, while growth in the US and growth expectations are looking quite bad. Because last week's GDP update from the US showed a slightly better than expected reading on Thursday, but growth in US GDP fell from above 3 to 2.4% in the last quarter of last year and is expected to contract by nearly 3% in the first quarter of this year. Yes, nearly 3%. This is what Atlanta Fed's GDP Now forecast suggested at its latest print. The forecast fell sharply to minus 2.8% on Friday. So that would be obviously a huge drop in the US growth from last quarter of last year. The PCE index, on the other hand, which is the Fed's favorite gauge of inflation, printed on Friday a higher than expected figure for February. The core PCE advanced to 2.8% instead of a steady 2.7% read expected by analysts. And the University of Michigan survey shows that inflation expectations keep rising while consumer sentiment keeps dropping. So in summary, the US data hints at a stagnant and worse, slowing US economy and rising inflationary pressures. That is the worst possible combination for risk sentiment, mind you. Now, good news is that the Federal Reserve, those are not going away these days with higher inflation and inflation expectations, as the rapid fall that we see in the US growth figures look much more concerning to the markets and to the Fed those than the inflation pickup. Therefore, the Fed is still expected to cut its interest rates in June, despite an unideal trend in inflationary pressures with more than 80% probability. That's printed this morning on FedWatch. The pricing in the bond markets also tell the same exact story. The US 2-year yield that best captures the Federal Reserve rate expectations actually dropped below the 4% level last week and has settled near the 3.85% level this morning. But alas, even the falling yields and the rising dovish Fed expectations are unable to give a smile to investors right now. The S&P 500 lost nearly 2% on Friday's trading session and is set to end the month with more than 6% losses, while seasonally speaking, March could have been quite a good month, but it has not been. Nasdaq 100, on the other hand, was hit by a 2.60% sell-off on Friday. CoreWeave, which is the NVIDIA-backed cloud computing company specialized in AI, had quite a disappointing debut on Nasdaq on Friday as well. The company had to review its IPO price to $40, remember, down from $47 to $55 range that it aimed initially, and the stock was worth about that price, so $40 per share level at the end of its first trading session. Elsewhere, the Dow Jones Industrial Index, small and medium caps in the US, all traded down between 1.5% and 2% as well on Friday's trading session. Stocks in Europe, on the other hand, returned to the lowest levels in 2 weeks as gold continued to advance toward the fresh high levels. The price of an ounce is trading above the $31.10 per ounce level this morning as the sell-off continues in Asian markets, with Nikkei down 1.5% after a nearly 4% drop on Friday, and that despite data pointing at a 2.5% jump in Japan's industrial production in February, and the Chinese CSI 300 index is down by about 1% at the time I'm talking here this morning, and that despite a set of better than expected PMI numbers from China. Oil, on the other hand, is down as well this morning, and that despite Donald Trump being pissed off with Vladimir Putin for suggesting ways to install new leadership in Ukraine by sidelining the Ukrainian president Volodymyr Zelensky. So that's a situation that could eventually lead to secondary tariffs on Russian oil, according to the latest news. Alas, oil bulls are unable to rebound on the normally the price supportive news this morning. Last week's failure to clear the $70 per barrel resistance is now leading to a toppish sentiment, and the latter is further reinforced by gloomy growth expectations, and OPEC Plus plans to start restoring its oil production from next month as Donald Trump wants to make oil cheaper for everyone. So this is the situation right now. In the FX markets, the US dollar reversed an attempt last week to rebound from the March dip levels and is down for the third session on mediocre growth expectations for the US economy. The euro dollar, on the other hand, managed to find support near its 200-day moving average last week. That's an encouraging development for the euro outlook. Also released last Friday, the French and Spanish early inflation figures for the month of March came in softer than expected by analysts, providing more room for the European Central Bank to stay accommodative to support growth in the Eurozone economies. And the euro's appreciation and the weakening energy prices are also supportive of the European growth story, as one of the reasons, remember, that actually pushed the European economies, and especially the German economy, into economic slowdown and economic despair over the past years was the high energy prices. So the higher the euro, the weaker the energy prices, and the more contained inflation in the Eurozone, the better the growth expectations, and the better the growth expectations, the better the euro appetite. As such, the euro's outlook remains positive right now. And speaking of growth, well, the British GDP update surprised to the upside on Friday as well, giving cable an additional reason to stay strong against a broadly softer US dollar, though note that sterling remains offered against the stronger euro elsewhere, as growth expectations are improving more strongly for the continental European economies than for the United Kingdom, that's stuck with a narrowing spending budget. In summary, the euro is looking better than sterling and the dollar, while the US dollar is now becoming the weakest link among the three. This week, investors will continue to watch the European inflation numbers and the US jobs data, and expectations for the US jobs data are weak. So if the Liberation Day doesn't lead to a relief rebound in the US dollar in the second part of this week, well, we could very well see the euro and the week above the 110 psychological mark, and cable break the back of the 130 psychological offers. So this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.